Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
I'm doing great. Thank you for having me on, Ross.
Yeah, good to talk to you. I want to start with long bond yields, obviously very important, a key benchmark yields for a lot of things that consumers see in the world. Asking anyone in this environment to make sort of a forecast or prediction seems pretty fraught, but I wondered if you could give us your outlook for the 10-year yield, over the next 6 to 12 months, or at least maybe talk through a couple of the scenarios that are in play.
Yeah, thank you, Ross. And so our base case scenario is that there has been enough damage done to the U.S. economy from not just the actual implementation of the tariffs, but the uncertainty that the rollout has caused, so that the U.S. economy should enter into a shallow recession sometime in the middle half of this year. Now, that in the near term should outweigh any long-term inflationary pressures and supply pressures, which could push long duration interest rates up. And so we think that in the very near term, let's say between now and the end of the third quarter, you should see long bond yields drifting lower. How much lower? Well, in a typical recession, which we don't think we're going to see, but something more shallow than that, but in a typical recession, you might expect to see 10-year yields drop 200 basis points from sort of their peak to their trough or more as the economy begins to play out and the recession begins to play out. That would suggest that if you look at a peak of 10-year yields of 5%, that at least we should be going down to 3% or even lower. But I think this is not going to be a typical recession, in part because this is very likely to be driven by a overdue pullback in the consumer, which is fairly shallow and driven by, in particular, lower income households pulling back. And so that should also that should by itself should sort of limit the downside on treasury yields. But also we have to deal with the consequences of reduced global trade. And I think it was Larry Summers, the former Treasury Secretary, who put it out there, who said something to the effect of, if you're going to have a smaller trade deficit, you're going to have a smaller capital surplus. What that translates to in English is simply there's less buyers of treasuries, particularly long duration treasuries, in a downturn. And so that should also lead to less downward trajectory of long-term treasury rates. So big picture, we see in this shallow recessionary outlook for the US something around a 350 to 360 as a bottom in 10-year treasuries sometime between now and September. From that point on, assuming the US economy begins to get its sea legs back and growth moves back to that 2 to 2.5% range by the end of this year or early next year, you should very easily see 10s pushing back above 4%. And if we have continued growth next year, with treasury supply beginning to rise and inflation making another turn higher, you should very likely see 10s making a move back to 5%. So big picture, long story short, I think we're looking at a continuation of the roller coaster, up and down in yields. But in the next 3 to 6 months, I think we're looking at a downturn in treasury yields, long duration yields going lower.
Yeah, I think investors in many ways are going to have to get accustomed to the roller coaster type of environment in equities and in fixed income. So that leads to a question on, what you view as attractive here. With that, forecast for yields to head lower, at least in the near term, do you like buying a, longer duration fixed income here and taking that capital appreciation as yields head lower? And then a second question on positioning that I'll just let you expand on a bit. The dichotomy or the difference in return between treasuries and munis this year, what do you see as the driver there? And is that something that can continue for the rest of the year?
Well, on the first question is where would we see value and do we see value today? We would definitely see value at current levels, tens around 435 to 440. That's right in the zone where we've added duration in the last 6 months. And if we had not previously added duration, we would definitely be looking to add duration again. So we would be buyers on the view that tens are going to make a move, at least one more move lower, down below 4% between now and the end of the third quarter. So we would definitely be buyers there. But I have to caution that, again, this is a roller coaster. I think we're going to be down and up and down and up. And any given day, we could be either of those, both in any given day, because there's just so much uncertainty in the global trade outlook. In terms of the divergence between munis and treasuries, I think part of the problem you might be seeing, again, treasuries are moving in ways that are not entirely intuitive, and the muni market itself is probably not getting a firm bid on given days because the treasury market's too volatile. At the same time, you're not prone to see the type of selling in munis as investors liquidate sort of safe havens as they get margin calls. So you may see long, prolonged periods where the muni market might actually outperform treasuries, and then there's a catch up where they lag and underperform. I wouldn't want to read too much into that. I think it's just simply a matter of you have your treasury curve, which has become very, very volatile, and you have a similar government, higher quality government type curve, the muni curve, which is not trading in real time and is lagging those moves. And it seems to be diverging on any given day, but I wouldn't read too much into it in either way, outperforming days or underperforming days. It's just simply a lagging a market where you're seeing less selling activity and less buying activity as well.
Awesome. Well, Tom, thank you so much for the update. Appreciate the time, and we'll look forward to talking to you again soon.
Thank you, Ross.